Okay, let's go to order the Retirement Plans Advisory Committee.
Here we go.
Roll call. Here. Okay, I'm saying that wrong. I'll keep you going. Yeah, seems to be good. Tom. Here. Michael.
Here.
Okay, and Neil is here. Okay, let's look at the minutes. Can I have a motion for approval of the minutes for the April 6th, 2022 special meeting?
So moved.
Second? All in favor? Right. Okay, investment performance. The purpose of this meeting is to do an updated investment performance. We had one in last month's package for the Board of Finance, but this is an updated one. And this one will actually be delivered to the Board of Finance, so you get to practice once and then do it ready. But I think to Brian, he's probably got the most dynamic area to talk about tonight. Things constantly change. So let's hear about investment performance.
And is the electronic copy of what you're talking from in your, I have a 3:20-ish email from yesterday, but it had some additional.
Oh, at
Few more
3:20
pages.
p.m. Yes,
Yeah.
that should be the most recent version.
So is that the one you had, Michael?
Yes,
It was-
I have that, yeah.
In the Zoom meeting, I'm just looking for the share my screen so I can pull it up on here.
Oh,
Should it be?
Do we need to, we control that? One participant share multiple.
Pam, are you able to share this? Let anyone share the screen?
Yeah, I don't see where I
It's
can
the-
share screen.
You're on mute, Pam.
I made Brian co-host, so he should be able to share his screen.
Okay,
Oh, there we go.
great. Thank you, Pam.
So note for next agenda is to invite the IT help desk. to-
Right.
Although I think we can all get extra points for stumbling through pretty well.
Yeah.
It's only 2 years into using it. Exactly.
Yeah.
I had this slide up because Neil was trying to give me some trivia on how long a fair market usually is. And
You
I
know,
said,
Now, tell me, what is the average duration of a bear market?
so the bottom is 236 days, so just shy of a year.
Okay.
Of how long an average bear market lasts, but you know, the average total return you see there is negative 28%, so it still hurts. I mean,
But I would have guessed longer, wouldn't it? You guess?
I would have thought it was longer too.
It certainly feels longer when you're in the middle.
right.
That's a good point.
And the definition of a bear market is what, consecutive quarters of,
The definition of the bear market would be a
Down
20% correction from the top.
okay.
A correction would be 10% from the top. So we are certainly in correction territory
Right.
and approaching bear market, but not officially in a bear market as the markets would define it. You'll see it in small print, that decline of 20% or more, lasting at least 2 months.
Okay.
Yeah, so, but let me go to the front of the presentation. I just happen to have that slide up.
Yeah.
And Michael, hi, we missed you at the last meeting, and I know that there's probably a lot of things that we covered at that last meeting that you weren't there, and so I want to be able to address those as well. Because I know like 2 meetings ago, we had talked about, you know, other asset classes, we discussed those, and really, you know,
And that's when I said I was aware the equities was at a stock bubble, if you remember that.
I do, I was just about to say, I mean, really what you're talking about has come to fruition as far as, you know, equities and fixed income down together, which is extremely rare. We haven't seen this kind of, I'd say, bear market in bonds almost ever. You know, from January to April, a decline of more than 10% in fixed income, and that I think you have to go back over a century. But with that said, you know, I think it's more, and I included this when we get to the section about our discount rate or estimated return on assets, is you know, you could shift into other asset classes and you can go to a multi-strategy fund or, you know, hedge fund, but it will impact, your discount rate, right? So we can seek protection in the sense of non-correlated asset classes, but it will have an impact on what the return projection is over time. Because a lot of those products are benchmarked to like a treasury bill. And that's what you would use as an index when determining your forward-looking projections. So I'll come back to that, but I know you had a lot of questions, and I'll try to address them. I'll try to move through the historical stuff kind of quick, just to do a quick recap. So we have a lot of time to have a conversation. So what I'm showing here on page 4 is the snapshot of the major stock and fixed income indices. So on the left-hand side, this is all through March. I can give you a quick update through April, but I'll warn you, it's not any prettier. So through the first quarter, US stocks were down 5.4%, non-US stocks down 5.3%. And the real surprising one is US bonds. That's just the broad Bloomberg Barclays aggregate. And that's US bonds on the page in the middle, down 6% in the first quarter. So that's the rare event where we had both of those markets down. You used to seeing when equities are down, there's a flight to safety and fixed income is up. But as we kind of are all aware, what's driving this is really the inflation, and the byproduct is just the rising interest rate environment that we're in. And so what I'm showing on this chart is the yield curve. Just those are interest rates at different maturities. And the market is always forward-looking, whether that's equities or fixed income. So the market has already been pricing in what they think the Fed is going to do. Now that's somewhat of a moving target, but the short end of the curve is that's where that's reflected, because that's what the Federal Reserve has most control over, is the short-term bond, yields, because they can raise interest rates. So you see the 2-year yield, in a 1-year period is up over 200 basis points. And so it's happened so quickly, and the magnitude has been so great. And that's what's led to the broader sell-off in fixed income. The 10-year yield on the right-hand side is still, it's been moving up since March, but fairly well grounded in the longer term. Now it's up over 3%, but at the time it was still less than 3.
So it's so healthy for us to have a fixed income market, right, which you didn't really have.
Yes. And so that's the silver lining. And I might have included a slide on this last time, is that, for so long, investors, including Town or any institutional or retail investor, wasn't able to earn anything from fixed income. And that really impacts portfolio returns. So it may take time to get back this loss in fixed income, but as bonds mature or coupons are reinvested, you're now reinvesting at a higher rate, and that'll start to accrue over the long term. So that's the silver lining as far as higher interest rates, is that investors can now make something off of fixed income. I think there was another point there, but that's the main point with respect to fixed income. Oh, my other point is most of fixed income return comes from your coupon or your income, less so the price return.
Right, if you're holding them to maturity, you're just getting the coupon you bargained for, right? It doesn't matter what some speculator would give you on this month or that year if you're kind of one of those, right?
Right, and right now some of the bonds that have lower coupons are a discount, even though you have to.
Right, if you were compelled to have to exit or liquidate or whatever, then it really does matter what someone would give you for it. But
yes.
If you have a hold to maturity strategy.
So you take a loss on the portfolio of bonds, you do have.
Right,
Yes.
I mean, you don't believe in it, realize it.
right.
And as a town, we're not going to be speculating. Like
Right.
individuals might. I don't see us.
Maybe somebody would like to speculate. Very close.
Yeah, I think where it comes into play, and others that aren't the lawyer side of things might have a different view of this, but it seems to me that I'm not so worried about, or overly worried about, the perceived shrinking in value of what somebody might give it
Right.
me today, because it is kind of a holding to maturity, and I am getting my bargain for coupon, et cetera.
Right.
Yeah.
However, we do gladly reap the benefits when it flips and someone's willing to give me somewhat more, and I think, oh, hey, look how
Mhm.
rich this valuation is. And then we might be making decisions on the basis of a somewhat, a portfolio valuation that might be distorted on the other side.
Right.
That's the-
Right. One of the kind of golden rules we say with fixed income investing is as long as your time horizon is longer than the duration of your portfolio, then you're going to accrue those benefits of the higher yields. And our time horizon certainly is longer than the duration of the fixed income portfolio, which is about 6 years is the broad market. So, yeah, so that's the part of the fixed income market. Just as it relates to the fixed income market, the other segments on the left-hand side, we look at the different credit qualities. So for instance, if you just had investment grade bonds, they're down a little bit more than treasuries. That's because there's been some spread widening, but not a lot. You're almost back to about median. Even 3-6 months ago, credit spreads or yields over treasuries were at like 20-year tights. I mean, everyone was searching for yield. Same thing could have been said about the high yield market. And interestingly enough, not that we hold high yield, but the high yield market, is not showing signs of stress. They're not factoring in broader bankruptcies, at least at the current time. As credit continues to tighten, the high yield market may change, but there's not big stress within the fixed income markets. Most of the negative return is due to rising interest rates, not from spreads widening like we saw in 2008 or COVID. So I just wanted to provide that perspective. Just quickly, the biggest part where you've seen, this is only a 3-month look or a 1-year look. The 1-year look is kind of masked, but of course you've seen more of a rotation towards value stocks or more defensive stocks, energy being the biggest, winner there. That's on the left-hand side. The stocks that were most richly valued, mostly some of the tech companies, that's where you've seen the biggest decline so far in the market. And as a reminder, we hold the total market, across all styles and market caps. So, but before I just turn to the performance of the plans is going to closely mirror what I just said. I'll just pause, and also if there's a lag, Michael, do you have any questions or comments?
Now, you don't have Peloton in your portfolio, I hope.
If it is, it's pretty small.
Yeah.
It's pretty small.
It's lost like 95%.
Yeah.
But no, I think it's reflective of what I would think, right, for a portfolio in the first quarter. It's
Right.
very close to benchmark.
So this is where we are at the end of the quarter, quarterly return or 1-year return, quite different from when we were here last year. But so the overall portfolio for the quarter are down 5.78%, right here at the top. You might wonder why we lower than the benchmark return for an all index portfolio. That has to do with the topic that we've talked about in the past about fair value pricing in the international markets. I can go over that, but there's sometimes a price lag. But you see in the short term, the difference between the international markets against its index, and that's mainly a result of all the volatility that we've had, but that reverses itself over time. The good thing on a 1-year basis, still positive, small, but still positive, over 3%. And then, longer term, which we're always focused on, from an absolute standpoint, I don't know what the discount rate was 10 or 15 years ago, but the absolute performance, I think has been close to or in excess of the discount rates. And that's what has the biggest impact on the town finances. Down below is we always show where the current allocation is versus the policy index. This has changed a little bit since the end of March, but if you recall, our rebalancing thresholds are plus and minus 5% at the asset class level. So we're still not there yet. And then just as a reminder, we do have cash flows, at least in the pension plan, that come out on a monthly basis. Roughly, I think it's 500,000-600,000 comes out, and we use cash flows to rebalance to our portfolio targets. So we do that first. If the market moves dramatically, then we rebalance at the asset class level.
How often is that done? The rebalance?
The rebalancing, only when we move outside a threshold of plus or minus 5% against the policy index.
Okay.
The reason we set the threshold at 5% is we feel that anything, if you moved like equities or 5% overweight your portfolio or vice versa, that shifts the risk profile of the portfolio that the committee we've established from a strategic asset allocation. If you set it any tighter, it doesn't do anything from a return perspective. You're just going to be rebalancing more frequently. So we think of rebalancing as more of a risk procedure as opposed to trying to get return. I think there's been 1 or 2 times. I mean, we certainly rebalanced during the COVID pandemic in March of 20. You know, equities got 5% their target weight. We sold fixed income, we bought equities. And there may have been one other time after 2020, I don't recall exactly.
In retrospect, that looks like.
And yeah, that's an overlooked part of, I think a good successful strategy is discipline. Discipline meaning not trying to time the market, talked about that, but also the rebalancing. And so rebalancing is part of that discipline process. That leads to good returns over time.
Brian, I
Yes.
have a question just because we're a lot lower than these numbers. We are not hitting up on rebalancing anytime soon. I haven't heard anything from you.
No, you haven't heard anything from me. I even checked this evening. Yeah, I don't think we're
Because they've been moving in tandem.
Yeah, I could pull up your portfolio. As
No, I know what it
yesterday's
is.
close, but yeah,
I don't know if we want to know.
we're not close. Yeah, I mean, you're right. If I gave you an update through last Friday, you know, US markets are down 14%. You know, the fixed income down over 10% as of last Friday's close on a year-to-date basis. So, yeah. But because those asset classes are down fairly close, you know, that we're not coming close to rebalancing. So the 3 funds that I have here, I mean, that's mirrors the returns that I just talked to on the other pages because they are the indices. And then as far as the relative performance, this is what I was referring to is, you know, you see the total stock market index down 1.8%, but the benchmark down 0.72. And that's mainly or majority due to fair value pricing. But, you know, again, over longer periods of time, the real difference between the fund and the benchmark is really fund expenses.
It's time things comes in pretty handy in terms of correcting a lot of things, doesn't it?
Yes.
If you wait.
The OPEB plan, very close. It doesn't, you know, the asset allocation is the same, but it doesn't match the performance exactly because you don't really have the cash flows that we do in the pension. So just from an absolute perspective, the first quarter down 5.76%. And the Mildred Marsley Trust just down 5.74. So they're all very close to each other as far as the quarterly returns or the one-year returns. Now, I put this slide in perspective. This is a slide that this comes directly from S&P, you know, the index provider. It's called the SPIVA, the S&P index versus active scorecard. And they update this twice a year, 6 months and every year. And it just says, how is active done versus passive, and whether it's a 1-year time frame or a 20-year time frame. So let's just take, you know, to interpret this chart, you know, all large cap funds, and this was through December of last year, but this says 85% of actively managed funds underperform the benchmark.
You love this slide.
Well, it provides perspective, you know, it's just like, well, how's active doing? Well, you know, active has struggled too, unless last year you were in the biggest tech names, which really concentrated. It was very hard to tell.
So in the last few days, I've noticed more people are saying this is going to be the time for the active manager. You know, they've said that for decades, but.
Right. And yeah, we've done studies of how active is done in bear markets, and it's inconclusive.
And you offer a product in active, don't you?
Oh, Vanguard does manage over $1 trillion in actively managed equity and fixed income. So yeah, we certainly do offer it. And it's been hard for some of those funds as well. But one thing that I try to remind others is like, we've also looked at actively managing, like what's the biggest success factor for active management outperforming? It's not terms like tracking error or concentration and active share. It's the fees. You know, what are the fees for active management? And lower fees, even for active management, that's the biggest predictor of outperformance over long periods of time. These are some slides that I just put in again for perspective. I think we all know this intuitively, but just in light of what's happening in the fixed income market, you know, it's still stocks are still exponentially more volatile than fixed income. So left-hand chart is just calendar year returns for fixed income. Right side is calendar years returns for equities. And the black dot is the worst intra-year drawdown for that asset class. So, you know, just looking at the chart, you know, you still have much bigger drawdowns for equities than you do to fixed income. But what we're seeing here in 2022 for fixed income, this is going to lead to one of the biggest drawdowns, at least since 1970, but further back that, you know, you'll be down 10% at least through April. You know, we've been showing this because there's been some portfolios that are very conservatively allocated. And even if you have a 30% equity, 70% fixed income, you know, you're down 10%. You're like, wow, I'm conservatively positioned and I'm losing a lot. And so it's a matter of, you know, you'll hear of the Vanguard and then we speak about this, you know, stay the course as long as the objective hasn't changed, you know, stay focused on the long term. And so this chart here is, yes, just the market over, you know, a long period of time, but you know, we do have bear markets from time to time. We forget about them in the good times, but the shaded parts is where we had bear markets. And so we've had, you know, 9 of them since 1980. So they tend to come every, you know, 5 or 6 years. And then to the slide I showed at the beginning, and what we were talking about is, you know, the bear markets tend to be shorter. Doesn't mean that the drawdown doesn't hurt. The average drawdown of 28%, but you know, bull markets tend to be longer and more rewarding as far as the average total return. Let's get
So
that.
this would be typical. You do a lot of municipalities.
Fair amount.
It would be typical in terms of the choices we've made in terms of equity, fixed income.
Yeah.
They'll be too light in alternative products.
Well, I think too light is a relative term. I think there's 2 things that, you know, I always come back to with the town of New Canaan. And one is the envious position the town is in as far as your funded status, right? You know, over 100% funded. I mean, at least of the last fiscal year, right? Mm-hmm. And, you know, Hooker and Holcomb they do an annual study and of just looking at municipal plans across Connecticut. This is just Fairfield County. This is showing discount rates and return. And I had it color coded as far as funded status, but the Hooker and Holcomb report, you know, only 8% of plans, and it's almost 200 plans that they track in Connecticut, have a funded status greater than 100. So that's what I come back to, and that'll dictate, you know, the asset allocation that you have as well. If you're less funded, I'm gonna pick on, say, like Norwalk here. For a certain reason, they're not over 100% funded. So therefore, some of those plans may go into alternatives. Norwalk does. They have private equity, they have hedge funds. It doesn't mean the asset class is bad. I'm not saying that. I'm just saying they need the additional return to help get to fully funded. And so investors tend to go towards alternatives. They can't get the return from the public markets.
Yeah, I was surprised that a lot of towns have these investments, not just Norwalk trying to reach for something, but
Yeah.
I asked you once before last time, and you went through a formidable list. I viewed it as so conservative not to do the products. And I'm just surprised. I think even some of the AAA towns.
Yeah, like, you know, Fairfield, town of Fairfield,
Yeah.
you know, their funded status is not poor, it's, you know, mid-80s. But they do have some private equity exposure and some private real estate exposure.
Yeah.
I think as far as the privates, I think it's a matter of size too. You want to have a sizable portfolio in order to make minimums.
Yeah,
Right, and not to make sure too much of your portfolio is illiquid. So I think the asset allocation has worked well for the town. And then let me go backwards to this page. We can jump around.
yeah.
This we have to refresh. I'll have a refresh slide here. It's going to be interesting when we refresh the capital market assumptions as of March, because this is still using December. We usually have about a 2-month lag. So just describing this slide again is here are your policy targets to the 3 asset classes in this instance. To the right of these asset classes are our capital market forecasts for, say, equities. So over a 30-year time horizon, they use 30-year because that's what Hooker and Holcomb uses. Our expectation at the midpoint for US equities is 5.2%, for international equities 7.9%, fixed income for lower 3%. So on a weighted average basis, at the median, looking out 30 years, the expected return for the town of McKean's portfolio is 5.82%. And you could see a band kind of going up to 6.3. But the current discount rate of 6 3/4, we'd say, and this is really for the actuary and the town side, is outside, our broadband, so on the high. So Neil, you think you're asking, maybe at a later point, it's a discussion of, the 2 levers we could really do is, we could bring down our return assumption, or we could add risk, namely equities or other asset classes to try to get to that higher discount rate. Those are the 2 main levers.
So I think we'll look at that in not this meeting, but we should consider them. Remember, you said it along, Michael, but.
Yeah, and I'm just going to jump ahead to one slide, and I'm going to pause for a discussion. So this was showing like Vanguard's forecast. Well, how do we do? This is just 60/40 portfolio. This is not your portfolio. And the last 10 years, the dark line is the actual returns, but this was our forecast, say 10 years prior. And so the actual returns over the last 10 years were generally within that 25th to 75th percentile. At the end of last year, you recall how strong the markets were. The actual return was higher than our forecast. But the other thing that I may remember when talking about this chart is looking forward, in this case, 10 years. And our perspective was like managing expectations, is that we had really the last 12 years or since 08 been really strong. And so it was more of setting realistic expectations, and that looking 10 years forward, we were only expecting a 60/40 portfolio to be, was that around the 4% range. So it was more of a matter of setting expectations.
Yeah.
So I hopped around. Let me stop for a bit and just get reactions, comments.
Well, in your general presentation, what you're going to do after this, I think bringing up that last point is where some people will be thinking about it. It's not the answer, but because I think most people just everything's great, man, everything is great, but maybe showing where some areas we could even improve more that our peers have done. That that sounds. I've sort of moved on it because at first I thought it was kind of risky and why do it, we're doing full funded well and all that. But more is better, right?
Well, more is always better. I guess I do take Brian's point, however, though, that when you talk about your peer communities, right? The other towns, they're not really our peers if their funded status is not the same. Because once you get your funded status over 100%, it seems to me our objectives are qualitatively different than a town who doesn't have that, doesn't enjoy that, right? We kind of got to the happy place. They're, for a variety of reasons, they need to reach in order to get to that happy place. I think we have had a continuing dialogue, and a good one, about is that discount. Yeah, how comfortable with that discount, right? How do we, right? And so far, I think we've done a good job, being reminded appropriately every time, did you think about this? Did you work? And we haven't yet seen a need to move, but again, as we asked Brian to do, he has reminded us, here's where you are, this is what you need to do. Fold this into your conversation, into your thinking, your dialogue. So I do think in the meetings going forward and seeing how, Q2 might unfold, et cetera, I think there probably is a worthwhile discussion for a future agenda on, are we there yet?
Yeah.
In terms of that discount for sure. And I think there could very well appropriately be, and again, being the kind of lawyer, not number guy here, there very well may be a legitimate role for alternative investments to kind of diversify downside risk, et cetera, right? And as Michael sort of predicted, if you have a situation where fixed and equities are both plummeting, maybe you want to have something else in the mix to kind of buoy the whole ship.
Right.
There could be any number of outcomes to that conversation, but it's a good conversation to have, it seems to me.
Yeah.
But I don't know what you think. I mean, is it the right way to think about it? That some of these communities that don't enjoy 100+ funding state,
Right, very few. So with alternatives, it's, it's thinking it through a couple of things. One is, at least at the extreme, say take private equity, you have to have at least a 10+ year time horizon, because you can't get out of that. You can get out of it, but then you're going to take a very big discount market to try to sell your private investment. So if it's private equity, the time horizon, you have to have at least 10 years. Recognizing also the cost for most alternatives are going to be higher than your public markets. So it's time horizon, it's complexity, right? I'd say it's cost, complexity, time horizons, at least on private equity. Private real estate, we've talked about a little bit more. I mean, there we have quarterly liquidity, so you still want to invest for the long term, but at least you have more liquidity in, say, something like private.
Brian, just on private equity, I'm more thinking of there's managed funds that invest in private equity companies where you can get out with like 6-month notice or whatever. So I agree with you, private equity is a 10-year horizon, but there's lots of alternative investments that invest in private equity to give you liquidity with 6-month notice or something like that. So, and they invest in various private equity companies. So they have lots of liquidity that way as an alternative. So just food for thought on that for private equity.
Yeah.
So you're not investing in one private equity company, you're investing in a fund that invests in private equity companies.
Correct.
Yeah.
So you're sort of indirectly investing in private, like you're
Correct.
investing.
Correct. You're investing in a diversity of private equity investments. Yeah.
Right. So, for instance, that's, we've partnered up with a firm up in Boston called HarborVest, who manages the private equity for our Vanguard clients. And that there's different strategies of private equity. You have primary investments, is that, you're investing in, say, a venture capital, a company that's just starting out. But then there's another segment of private equity referred to as secondaries, and buying someone else's private equity investment because for whatever reason they want to get out or they're over allocated. And secondaries, you can recognize return a little bit faster, but there's still usually a 6 or 8 year time horizon, even on secondaries. So there are different parts of the private equity market. It's just not one uniform market, as Michael was saying. I haven't come across, Michael, but I know you have a lot of experience in it, that, of private equity funds, even funded funds that had like 6-month liquidity. But.
Right. I mean, I'm not saying we should do that. I'm just saying if that's a concern, then there are options to address that concern. And again, private equity is only 13% in this case of the portfolio. So you could say for 13% of my portfolio, I'm okay with holding it for 6, 8, 10 years because I have liquidity on 80% of my other portfolio, right? So that's another way to look at it. Right.
So just quickly here, just this perspective, this is, I pulled some data. This is from Public Plans Database. This is kind of covers the largest. This is at more of the state. It has municipal plans too, but just to give you perspective, it's not so much the small towns. I'm trying to think what slide would I start with. So this is showing average asset allocation for state and local plans. And so the averages are along this column. But if if you look to the right-hand side of kind of the time, the allocations over time, just think at the bottom, the green is more equities, the yellow is your fixed income, and everything else is, I'm just going to call it alternatives, real estate, private equity, commodities, hedge funds. And the trend you'll see is like, wow, that's really increased, let's call it from the 2008 time frame or so. And what that I would equate that to is what we're talking about as far as, well, what do we need to achieve? And so this is looking at the average funded status of those same state and local plans. And you have, even despite the strong market returns, funded status has fallen over the last 2 decades at least for the biggest public plans. And one of the reasons that occurs is if you set a high discount rate that's not achievable, and you don't get that return, then you have to amortize that loss.
Yeah.
And that's kind of what happened or led to these declining funded status ratios for some of the biggest state plans. And then therefore, I would say that it kind of explains the bigger allocations to alternatives in seeking that additional return, broader than what the public markets can do. So just building on some of the stuff that you were just referring to, Tom, and just additional perspective as far as why is this shift happening, with respect to.
So I mean, the key question is, why wouldn't we look to emulate some of these portfolios?
Emulate them?
Yeah, with the allocation percentages.
The biggest thing I would still come back to, Mike, is the funded status and the discount rate. So, I mean, if we're emulating just for the purposes, I think we're missing the picture as far as, coming to the town's objective is, looking at your discount rate is 6.75. And again, that's the lever. Like, if we want to keep that discount rate at 6.75, then it may make sense to emulate some of the others in going into these other asset classes. But with your strong funded status, I think you'd want to take that into consideration in the whole discussion around discount rate and what other asset classes that we need.
Yeah, see, I'm worried about the volatility, as you see. Equities are very volatile. Bringing in other alternate investments, I think reduces your volatility. And I'm not sure it reduces your return, but it reduces your volatility for sure. As another example, I like real estate, right, as a hedge. Also, energy is a great hedge. Usually the correlation going back 20, 25 years, energy is kind of like reverse to most of the equity stocks. When equity stocks are going well, energy stocks don't do as well. But as you saw in the last year, when equities are struggling, energy does well. But when equity is doing well the last 2 or 3 years or 5 years, energy doesn't do well. So it's more of a hedge. I'm not saying that we should put significant amount, but all we're saying is that with alternative investments, you reduce your volatility. You have offsetting things that happen at different times. Consistency, hopefully.
I wonder, Michael, and it's a very good point. Obviously, it's an insight that I don't have, but I do wonder, kind of out loud, I'm asking, I don't really know the answer to this, but whether or not volatility is something that should play a similar role for a fully funded community. In other words,
Right.
I can understand volatility certainly has a role in any investor, right? At what point do you lose your nerve? At what point do you feel like, I'm jeopardizing the ultimate goal here and I'm putting at risk, sort of hard-earned capital value that took decades to get just because I'm, stubborn or whatever. I get that, but where your funded status is over 100, I'm not sure, if we were in the mid 80s, the volatility could throw ourselves, again, just talking about the value of the portfolio, if there was high volatility, that could throw your funded status down a couple of points, right? And now there's a greater margin between, what you're actually returning and what your discount rate is, and that's the amortization costs are going up, et cetera. And you're really kind of compounding your problems. But I wonder whether or not, again, volatility is to be avoided, but I wonder if it plays the same role if you're a fully funded community. I don't really know the answer to that.
Yeah, and then the discount rate, so I didn't have one slide on the public that wasn't there, but again, if I showed you the discount rate for those bigger public plans, the discount rate's more like 7%, okay? Not 6 3/4, but the trend has certainly been to lower the discount rate,
Yeah,
given, if we go back to our performance, we looked at the performance of the plan over the last 10 years, quite strong.
right.
So I think it comes down to the discount rates at the plan, because that dictates how much you have to contribute on an annual basis. And the other point on volatility with the alternatives, one of the reasons, at least one of the reasons that you get less volatility on a marked basis for, say, private real estate or private equity is you're only valuing those companies about once a year, right? So you're only taking a mark. They adjust a certain percentage of the portfolio each quarter, but usually you just have to adjust the portfolio once a year.
Right.
So this can get into a whole bunch of studies and say, well, it's less volatile, but if you really smooth it or look at those asset classes on a lag, the volatility is still closer to real estate, public real estate or the equity market. It's just, again, taken into consideration, you're not going to get a mark more than once a year for your private equity. You're going to get it quarterly, but each investment only has to be marked once a year. So that's one of the reasons it reduces volatility on the surface.
Well, so is, and again, I think all of these are conversations to be continued, which strikes me, and at least that's kind of what I feel. But so is the message for tonight, here's the performance results and, right, read them and weep. But then the second thing is because you have the asset classes all kind of plunging at the same time, we're not seeing any need to reallocate. Right?
Yes.
So that, and then the RPAC was going to continue to have a dialogue over, do we have the right mix?
Right.
In the context of, is that the right discount rate? And we're going to have, we're going to continue to do that. And that's kind of the message for the broader committee, right?
I think so.
Yeah.
I think,
Yeah, thanks for that summing up.
I mean,
That's helpful going into the next
Every time I
meeting.
come here, I try to reimburse
Yeah.
myself.
yeah, it's good though, for this audience, I think that they should know they're gonna be asked to make some, opine on some decisions.
Yeah.
And we haven't actually formed it yet, but it seems that it's likely that we're gonna make some changes.
Yeah.
Would you think?
Yeah, I would think so. I mean,
Yeah, right.
when you talk about the trends of the discount rate seems to be going, are the investors or the funds that are leading that trend tend to be the more fully funded ones who would stand to reason, yeah? Or
That's a good question. I don't know that. But in general, that's not unique to Vanguard as far as,
right.
if you had strong returns, if you look at the equity markets, the biggest predictor for future returns is really what valuation are you at? Give me one moment. This again, it was from 12, as of 12/31. The shaded area is more what we would consider fair value, but looking at a cyclically adjusted PE that was developed by Yale professor. But bottom line is valuations as of the end of the year, really we're approaching levels that we hadn't seen since the dot-com bubble, right? So the market was certainly getting frothy from a valuation perspective. So therefore, when you look out the next 10, 20, 30 years, whatever time frame you want to do, your expected returns are going to be lower. That's the biggest driver from the equity returns is your valuation starting point.
Yeah.
So just giving the perspective as far as why were future expected returns lower is because of how well the market has done. Really, again, I come back to 08, the real big financial crisis. And so therefore we pulled returns forward in a low interest rate environment.
Mm-hmm.
We pulled those returns forward. So we just, you know, we couldn't keep going at that pace. Valuations were getting stretched, and that's what you've seen coming
So we're
out.
very goal oriented. We took care of this problem.
Oh,
We achieved success. There's no more valuations like that, so.
Right.
Declare victory.
Yeah, so
Mission accomplished.
I think most, if I don't want to use the word all, public plans were reducing their discount rate over time.
Yeah.
Who did it by the biggest degree is a good question. I don't know if that's more
Yeah.
fully funded or probably the less funded you are, the harder it is to reduce
The
that
hard,
discount.
that's kind of where I was.
Yeah, yeah,
My own amateurish.
yes.
Guessing.
So I think that's a fair.
Yeah, look, up until now, I felt very confident of, you know, the decision to, you know, let's stand pat. I think we're still okay. I think we're, you know, I am feeling a need to have a genuine dive into that again, because I feel like there's more of a reason to, you know, consider an adjustment now than I felt previously. I'm not saying I'm there, but I agree with you. The next meetings, we're coming, we should certainly be prepared. And give ourselves a thumbs up or thumbs down where to go, and then obviously the magnitude of whatever change we might consider needs to be folded in as well.
And do you have a view from the municipalities you've seen, just when you see this, do you have a view one way or the other?
No.
Good, that's a good thing. Right?
Well,
You had a view.
my range is Wilton and Bridgeport, so,
Oh,
they're-
wow.
you know, they're
Talking
too,
about running-
yeah, I mean,
Yikes.
so.
You know, I have to say, I don't know whether or not this is, you know, sort of silly, over, you know, you can overanalyze things with data and statistics, but I'd be interested to know of the peer communities, how recently each one has adjusted. You know, it just might be a good data point to get in our mind, like, oh, these guys adjusted at this point, and then we would, you know, take into account what their funding status is and how big they are, et cetera. So that might be kind of interesting.
We could do that for you all, because I think we've been showing this chart for at least the last 3 years.
Yeah.
Yeah.
So for the, you know, the towns, you know, Fairfield County, we can look at least the last 3 years of how much people have reduced the
Yeah.
discount rate.
I think that's good, that would be good.
So I'll take that as a takeaway.
And doesn't like GFOA, the state GFOA have, you know, sessions or workshops or do people compare notes? Or is it just
I haven't seen it in a while. I mean, the only ones I've seen being changed right now in the last year or so is the mortality rates. I haven't seen the discount rates change as much as the mortality rates.
That's interesting.
You know what, I have to say, I don't know what level of mortality rates we're on right now. I don't know which one of that, and that's more on the actuarial side.
Right.
But I've seen that change more.
Yeah, I remember that. Living in the actual-
I know Westport and Darien, they've been at those lower rates for a while. They were like the leaders to go below the 6.5. I said Westport and Darien, yeah. Greenwich tends to, they've been doing it a little at a time for the past 5 years. They've been dropping an eighth or a quarter. The other towns, I don't know so much. I don't think Wilton's changed
Oh, we
theirs in a
haven't.
while.
But
Yeah.
they're way overfunded.
They're not on that slide. I know.
And could, I guess, you know, as we anticipate going forward, what we might need to arm ourselves and to gather the courage or whatever to make decisions, it would be helpful to see what a change of an eighth or a quarter might mean in terms of, you know, all other things being equal, what does that do to our cash contribution?
And
What does that do?
if you remember, it's pretty scary.
It's like.
It is.
It is,
it's a-
right, it can really mean
Half
a
a
lot,
million.
right, exactly. And you know, there's a
Right.
lot of things that are coming up just from a budget perspective, right, and next year's a revaluation, right?
Yeah.
Yeah,
And so we think house values have been kind of goofy crazy, so all those really big ticket homes on the other side of town that took a bath in the 5 years ago one, that they could come rocking back and you could see the total, right? I mean, I could see a mill rate plunging. Yeah, personally, but, so it would just be helpful to see what that is, because as we make the decision about what's best for these funds, I think we would need to be able to discuss to the larger committee what that means in terms of current obligation. So if there's some way that that can be, it doesn't, but there's something that can give us so that we're
Actuaries.
conversant.
They could put where we are now and just do an estimate,
They
yeah.
do that.
I know
Yeah.
they've done
They
that
do
in the
that.
last year or so, and I think it was around $500,000. But
That's what I kind of remember, but
Yeah.
yeah.
Right, you don't have.
Every,
I remember seeing the number, that's
Yeah.
real money, you know.
because I think
Right,
we
well-
looked at this about a year ago, and we should just be careful with time.
Yeah.
A year, it's almost like every January, we look at it as the budget discussions are coming up, and
Right, but if we're thinking of maybe doing this, mid to
You need
late
to get
summer or
a-
something.
yeah.
And I want to make sure that Todd and other members all understand what we're doing, and so we're all kind of knowingly and inadvertently saying, notwithstanding the budget effects here, we still think it's in the best interest of the three funds to get X, Y, Z.
I could leave this meeting. It doesn't carry over to the next one, right?
no, I think the law
The different
is
is lower,
lower.
yeah, it's a different.
Okay, so
Just to confuse you further, that you
Yeah,
have to do this
yeah.
all over again.
how much time should I budget for the next one? I know, I think what we talked about is good. I know there'll
Well,
be questions, but
Wait, they put on the agenda the time
You give it a
commitment.
little block of time.
Oh, there isn't anymore.
I would say, wouldn't you say 20 minutes?
I would say 15 or 20 minutes
Yeah.
in
No problem.
total.
no problem. Yeah.
Yeah.
So maybe I'll speak less. I'm
Yes.
sure there's questions. Okay.
So-
Oh, we're
Really
just,
helpful.
adjourn,
Yeah.
is there a motion to adjourn?
We get great service.
Neil, do you
I
want?
appreciate it.
Yeah.
Yeah. Make a motion to adjourn.
Yeah,
okay.
I always say how you do it.
I second.
It's really
Okay.
structured.
all right.
Adjourn at 6:54?
Right.
Sure.
No,
Thank you.
no, I mean.
All right.